There's a guy who retired last year with $3 million. He's paying $48,000 a year in taxes and Medicare surcharges he didn't need to pay. His neighbor retired with $2.2 million, pays half that. Same lifestyle, same zip code, different accountant. Meanwhile, there's a couple in Austin who retired at 55 with $1.8 million, spent a decade traveling and doing consulting work they actually enjoyed, and landed at 65 with $3 million and change. 3 households, 3 totally different outcomes, and here's the thing that nobody tells you. The number on your Schwab statement doesn't determine your retirement. Your income architecture does. The way you pull money out, when you turn on Social Security, how you sequence your withdrawals across different account types. These decisions create your actual life, not the headline net worth. And most people optimize for the wrong scoreboard. They chase the 7-figure milestone, screenshot their portfolio when it crosses $1 million, then realize they have no idea what that actually buys them in monthly grocery money after the IRS takes their cut. So here's what I'm going to walk you through. First, what 1 million, 2 million, and 3 million actually translate to in real spendable income, not aspirational Instagram captions. Second, the 3 structural levers that separate a tight retirement from a comfortable one. How you withdraw, when you claim Social Security, and how you think about your total income stack beyond just the portfolio. And third, why the biggest wealth destroyer in retirement isn't market crashes. It's the tax code, required minimum distributions, and Medicare income-related monthly adjustment amounts that nobody warns you about until you're 73 and getting bills you didn't budget for. By the end, you'll understand why 2 people with identical net worths can have wildly different lives, and which decisions actually move the needle. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Let's start with the $1 million retirement, because this is the number that lives in most people's heads as the finish line. You hit $1 million, you made it, time to buy the boat. Except here's the reality check. If you retire at 67 with $1 million and you follow the classic 4% withdrawal rule, you're pulling $40,000 a year from the portfolio in year 1. Now, that 4% rule comes from research by a financial planner named William Bengen back in 1994, later backed up by something called the Trinity Study. They stress tested different withdrawal rates against historical market data from 1926 to 1995. The finding was that 4% initial withdrawal, adjusted annually for inflation, survived most 30-year retirement periods. So it's a decent baseline, not a law of physics. Now you layer in Social Security. Let's say you're getting $2,000 a month at full retirement age, which is about $24,000 a year. Your actual benefit depends on your earning record, but we're keeping this simple. So you've got $40,000 from the portfolio, $24,000 from Social Security. That's $64,000 a year before taxes. Is that enough? Depends entirely on your life. If you own your home outright, if your mortgage is paid off, if your cars are paid off, if you've already front-loaded the big expenses of life, and you live in a place where $64,000 goes a reasonable distance, you might be fine. You're not traveling to Europe twice a year, but you're not eating ramen either. But if you're in San Francisco or Manhattan, that same $64,000 before taxes suddenly feels like you're still working, but without the paycheck. And here's the thing most retirement calculators don't tell you. Real spending doesn't stay flat. There's this research by a guy named David Blanchett that looked at actual retiree spending patterns. And he found that real spending tends to decline about 1% per year as people age. You spend more in your 60s when you're active and traveling and doing stuff, then it naturally tapers off in your 70s and 80s as your lifestyle shifts. Health costs might rise, but discretionary spending on travel and hobbies and all the fun stuff tends to drop. So if you're willing to plan around a gentle glide path where you spend more early and less later, you can actually model higher starting withdrawals without blowing up the plan. Instead of 4%, maybe you start at 5%, which is $50,000 from the portfolio. Or 5.5%, which is $55,000, or 6%, $60,000. Combined with Social Security, you're suddenly looking at $74,000, $79,000, $84,000 a year. That's a meaningful difference in lifestyle. But those higher rates only work if two things are true. One, you actually expect your discretionary spending to ease over time. And two, you're not asking the portfolio to carry 100% of your lifestyle forever. Which brings me to the concept of the income stack. Not every retiree has additional income sources, but a lot do, and they change everything. Maybe you've got a rental property kicking off $12,000 a year. Maybe you do some light consulting work you actually enjoy, not because you need to, but because it gives you structure and purpose. And that brings in another $15,000. Maybe you've got dividends from a taxable brokerage account. Even an extra $1,000 a month, $12,000 a year, shifts the entire picture. That turns your 4% baseline from $64,000 to $76,000. In your higher glide scenarios, you're suddenly in the mid-80s to high 90s. So the story of the first million isn't really, is it enough? The story is, how do I design an income stack so the plan feels stable instead of fragile? Because here's what nobody tells you. The number on the screen is just potential energy. It doesn't become your life until you convert it into monthly cash flow. And the way you design that conversion, that's the whole game. Now let's move to the 2 million profile, because this is where things get interesting. The second million doesn't just buy you more of the same. It buys you design choices. Let me show you what I mean. Imagine you step away from full-time work at 55 with 2 million invested. You don't want to go straight from career mode to full retirement. You want to design a runway into your mid-60s. So here's how you think about it. You split the money into two jobs. $800,000 is your early lifestyle runway, funding age 55 to 65. That's 10 years. The other 1.2 million is your long-term core, untouched, compounding from 55 to 65, then supporting you from 65 onward. Now, the runway bucket only needs to last a decade, which means withdrawal research gives you way more room. For a 10-year time horizon, you can sustainably pull 6 to 8 to even 10% a year without destroying the portfolio. 6% of 800,000 is 48,000. 8% is 64,000. 10% is 80,000. That's your freedom decade budget. But here's where the psychology gets fascinating. Most people I know who retire early don't actually want to sit around doing nothing for 10 years. Maybe you pursue some creative work, some consulting in your field, a few hours a week doing something you actually enjoy. Maybe it's coaching, teaching, running a small side business you've always wanted to try. Even if that brings in $20,000 to $40,000 a year, it completely changes the math. Let's say you generate $30,000 a year from flexible work during your 55 to 65 runway. Instead of pulling $80,000 from the portfolio, you're only pulling $50,000. Or you pull the full 80 but reinvest the 30, letting your long-term core grow even faster. Or maybe you front-load the experiences. You travel hard. You spend on hobbies and family and health while your energy is still peak. The optional income doesn't just preserve the portfolio. It gives you purpose and structure during a decade when a lot of retirees struggle with identity. You're not retired. You're self-employed on your terms. Now, what are you left with by age 65 if you do this intentionally? Let's assume 7% annual returns on the portfolio, which is in line with long-term estimates for a balanced or slightly growth-tilted allocation. If you're withdrawing a fixed dollar amount each year and the remaining balance compounds at 7%, here's what happens. At a 6% withdrawal rate, $48,000 a year, your $800,000 bucket ends around $910,000 by age 65. At 8%, $64,000 a year, it ends around $690,000. At 10%, $80,000 a year, it ends around $470,000. If you're bringing in even $20,000 to $30,000 extra per year from flexible work and either drawing less or reinvesting it, those ending balances could be $150,000 to $350,000 higher. Meanwhile, your 1.2 million core bucket has been sitting there compounding at 7% for 10 years. By 65, it's grown to approximately 2.4 million. When you recombine the buckets at 65, your total portfolio is roughly 3.3 million with the 6% runway path, 3 million with the 8% path, or 2.8 million with the 10% path. Even if you spent aggressively and worked 0 hours, you're landing at 65 with more than you started with at 55. That's the power of letting a portion of your money compound untouched while you live off the rest. Then, at 65, you're back to a more traditional long-term lens. Let's say you apply a 4 to 5% starting withdrawal rate. With a 6% runway path, 3.3 million at 4% is 132,000. At 5%, it's 165,000. With an 8% runway path, 3 million at 4% is 120,000. At 5%, 150,000. With a 10% runway path, 2.8 million at 4% is 112,000. At 5%, 140,000. And that's all before Social Security kicks in. Here's where Social Security timing becomes a massive lever that most people completely underestimate. If you turn 62 in 2025, your benefit at 62 is about 30% lower than it would be at your full retirement age of 67. Let's say your full retirement age benefit is $2,500 a month, $30,000 a year. If you claim at 62, you get about $1,750 a month, $21,000 a year. If you wait until 67, you get the full $30,000. If you delay until 70, your benefit grows roughly 8% per year between full retirement age and 70, landing you around $3,100 a month, $37,000 a year. That's a $16,000 annual difference compared to claiming at 62. And remember, this is inflation-adjusted income for life. So in our 2 million scenario, here's how the timing plays out. Option A, you claim at 62. You're 55 now, so Social Security doesn't start for 7 years. At 62, you add $21,000 a year to your income. Combined with your portfolio withdrawals, you're looking at $70,000 to $100,000 total during your early freedom decade. Option B, you wait until 67. You fund your entire 55 to 65 runway from the portfolio and any flexible work. At 65, you're withdrawing from 2.8 to 3.3 million at roughly 4 to 5%, giving you 112 to 165,000. At 67, you add another 30,000 from Social Security. Your combined income jumps from 142 to 195. Option C, delay until 70. You continue withdrawing from your portfolio through 70. At 70, you claim Social Security for $37,000 a year. Your combined income now becomes 150 to 200. And that higher Social Security benefit is inflation adjusted for life. The math here is really about longevity and sequence risk. If you expect to live into your 80s or 90s, delaying Social Security can be one of the best, highest return investments you can make. It's guaranteed, inflation protected, backed by the government. But if your health is uncertain or you want more cash flow early, claiming at 62 or 67 still makes sense. And here's another design option. You could run higher withdrawal rates in your early years, then step back down once Social Security kicks in. From 55 to 62, draw 8 to 10% from your runway bucket because its only job is a 7 to 10 year job. Age 62 to 67, claim Social Security, then reduce your portfolio withdrawal to 5 to 6% as Social Security offsets some spending. At 67, step down to sustainable 4 to 5% withdrawals from the recombined portfolio with full Social Security layered in. This step-down approach mirrors real retirement behavior. You spend more in your active years, then ease back as discretionary costs decline. It also reduces sequence of returns risk because you're not locking yourself into one static withdrawal rate for 30 years. Your income stack becomes a living, breathing design. Portfolio withdrawals vary by decade. Social Security timing is a strategic choice. Ongoing brokerage income, rentals, or flexible work adds cushion, maybe a small pension or a spouse still working part-time. The second million isn't just twice as much income. It gives you the ability to say, I want a very active decade in my late 50s and early 60s, maybe doing work I love on my terms, and I still want a strong 6-figure base in my mid-60s and beyond with Social Security timed to maximize lifetime benefits. You're matching the money to the mission, not forcing one withdrawal rule to do everything. Now let's look at 3 million, and I'll use a married couple retiring around 65 because that lines up with Medicare eligibility and feels realistic for many higher asset households. On a 3 million portfolio, different starting withdrawal rates look like this. At 4%, 120,000. At 5%, 150,000. At 6%, $180,000. Then we add in Social Security. Let's say between the two of them, they're looking at roughly $50,000 a year combined, at or near full retirement age. The real number depends on their earning history and claiming ages, but this gives us a workable ballpark. So very roughly, their starting household income ranges from 170 at 4%, 200 at 5%, to 230 at 6%. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. At this level, you're firmly in optimization territory. Again, I wouldn't model that as totally flat inflation-adjusted spending. That same spending smile research applies here too. Real spending often eases in later years, especially discretionary categories, even as healthcare might rise. For some 3 million households, a higher starting rate paired with a planned glide path can be reasonable if the plan is built around a realistic budget, thoughtful sequencing of withdrawals, and tax-aware planning around Social Security and Medicare. This is where the third million often buys you a different type of advantage, more control over timing and taxes, not just more stuff. Let me show you what that means with an example. Let's say our 3 million couple has their assets split like this: 2 million in traditional IRAs, 800,000 in taxable brokerage accounts, 200,000 in Roth IRAs. Between ages 65 to 72, they withdraw 100,000 annually from the traditional IRA to supplement Social Security of 50,000. Their combined income is 150. Their tax bill is roughly 22 to 25,000 a year because the IRA withdrawals are all ordinary income. Up to 85% of their Social Security gets taxed because of their high provisional income. At 73 plus, when required minimum distributions start, RMDs from the 2 million IRAs start to climb to 75 to 80,000 and higher each year. Combined with Social Security, their income now jumps to 125 to 130 even if they don't need it. They cross Medicare income-related monthly adjustment amount thresholds, adding another 2 to 4,000 a year in Medicare premiums. Their tax bill is 18 to 22,000 a year, even in lower spending years. Over 20 years, they pay roughly 400 to 450,000 in federal taxes and Medicare surcharges. Now let's run a different version. Same couple, same 3 million, but they restructure their approach. Between 65 to 72, they draw 80 to 90,000 from taxable brokerage, mostly long-term capital gains, taxed at 0 to 15% depending on their bracket. They do an annual Roth conversion of 50 to 60,000 from their traditional IRA, staying within the Medicare thresholds. They start Social Security at 67, 50,000 a year. Their combined income is 180 to 200, but their effective tax rate stays around 12 to 15% because of favorable capital gains treatment. Their tax bill is 18 to 22,000 a year, but they're converting 400 to 480,000 to Roth during this window. At 73 plus, their RMD years, their traditional IRA, is now closer to 1.5 million instead of 2 million plus. RMDs start at 55 to 60,000 instead of 75 to 80. They supplement with tax-free Roth withdrawals, 30 to 40,000 a year, to maintain their lifestyle. Combined taxable income is 105 to 110 from Social Security and RMDs. They stay well below the Medicare surcharge thresholds, saving 2 to 4,000 a year in Medicare premiums. Less of their Social Security is taxed, maybe 50 to 70% instead of 85%. Their tax bill is 12 to 16,000. Over 20 years, they pay roughly 240 to 280 in federal taxes. Same lifestyle, same spending. 150 to 200,000 in lifetime tax savings. That's what control over timing and taxes actually means in practice. And it's only possible when you have enough assets and enough planning runway to be strategic. Beyond the tax savings, they get predictable Medicare costs, flexibility in spending because Roth withdrawals give them tax-free access to extra cash for travel or gifts or unexpected costs, better legacy planning because heirs inherit Roth IRAs tax-free instead of traditional IRAs, and more control because they choose when and how much income to recognize rather than letting RMDs dictate their tax situation. So we've walked through each level. At $1 million, even with Social Security, you're usually living somewhere between $60,000 to $80,000 a year, depending on your withdrawal style and whether you have any extra cash flow. That's where the foundation starts. At $2 million, you can design an early runway in your 50s or early 60s and still land in your mid 60s with a strong six-figure income range from the portfolio plus Social Security. The second million buys you options. At $3 million, you're in a different band. You're often looking at high hundreds to 200,000 starting income once you combine portfolio withdrawals and Social Security with the ability to use glide paths and tax planning to keep that lifestyle strong for decades. The third million buys you control, especially over taxes and timing, which can save you six figures over retirement. Same markets, same country, very different lives, depending on which lane you're in and how you design the plan. Now we have to talk about the part that doesn't show up in most retirement calculators, taxes. Once you start talking about higher withdrawal rates and larger Social Security benefits, your after-tax picture becomes just as important as your gross income. There are three big levers that can cost you six figures if you ignore them. First is Social Security taxation. A lot of people still assume Social Security is automatically tax-free. It's not. The IRS looks at something called provisional income, which is half of your Social Security plus most of your other taxable income. If that number crosses certain thresholds, up to 85% of your benefit can be taxable. For a 2 million or 3 million household, big traditional IRA withdrawals don't just push you into a higher tax bracket. They increase how much of your Social Security is taxed. Two retirees with the same portfolio can end up with very different after-tax income based on this one lever. Second is required minimum distributions. As of 2025, at age 73, the IRS forces you to start withdrawing from traditional IRAs and many employer plans, and every dollar is taxed as ordinary income. The Secure 2.0 Act moved the RMD age to 73 for many people. For a household with 2 to 3 million in tax-deferred accounts, RMDs in your 70s and 80s can easily hit six figures a year, and they do two things at once. They push you into a higher marginal tax bracket, and they stack on top of your other income in a way that makes more of your Social Security taxable. This is why your 50s and 60s are such a powerful planning window. Strategic withdrawals and partial Roth conversions aren't just about being fancy. They're about shaping your future RMD years before the IRS forces you to take out more money than you need. The third piece almost nobody hears about until it shows up in their mailbox is IRMA, the Medicare Income-Related Monthly Adjustment Amount. If your income from 2 years prior is above certain thresholds, you pay extra on top of your standard Medicare premium. A big Roth conversion or one-time distribution in your early 60s can show up as higher Medicare premiums at 65 to 70, even if your income has already dropped back, because IRMA looks back 2 years. The point isn't never do Roth conversions. The point is to choose deliberately when you realize that income, looking at your Social Security timing, your pre-RMD years, and these IRMA thresholds together. Good planning here can save you six figures over your lifetime without touching your lifestyle. It's mostly sequencing and timing. Let me give you a real mini case study to make this concrete. Two couples, both in their early 60s, both with 2.7 million. Couple A has it all in traditional 401ks and IRAs. They retire at 64, start withdrawing $120,000 a year from the IRA, claim Social Security at 67 for $50,000 combined. By 73, their RMDs are $90,000 plus. Their total taxable income is $140 plus. They're in the 24% federal bracket, paying $30,000 plus in federal taxes annually, plus another $3,000 in IRMA surcharges. Over 20 years, they pay roughly $660,000 in taxes and Medicare penalties. Couple B has 2 million in traditional IRAs, 500,000 in taxable brokerage, 200,000 in Roth. From 64 to 70, they live off the taxable account, mostly long-term gains taxed at 15%. They do 50,000 Roth conversions each year, paying about 8,000 in tax on the conversion, staying just under IRMA thresholds. They delay Social Security until 70 for maximum benefit, 60,000 combined. At 70, they've converted 300,000 to Roth. Their traditional IRA is now 1.7 million instead of 2 million. At 73, RMDs start at 60,000 instead of 90. They supplement with Roth withdrawals. Total taxable income is 120. They stay in the 22% bracket, pay $20,000 in federal taxes, 0 IRMA surcharges. Over 20 years, they pay roughly $400,000 in taxes. That's $260,000 in savings. Same net worth, same lifestyle, different engineer. Here's the thing. Nobody tells you when you're chasing that million, 2 million, 3 million number. The number is just a trophy. It doesn't create your retirement. Your income architecture does. How you pull the money out, when you turn on Social Security, which accounts you tap first, how you think about tax liability across decades, not just tax years. Whether you design a runway in your 50s or go straight from career to couch. These are the decisions that turn a number on a screen into groceries and travel and medical bills and everything else that makes up your actual life. So here are 3 takeaways. 1, stop optimizing for the headline net worth and start designing an income stack. Portfolio withdrawals plus Social Security plus any other cash flow, sequence intelligently across different life phases. 2, your 50s and 60s are the tax optimization decade. This is when you have the most control over future RMDs, RMA surcharges, and how much of your Social Security gets taxed. If you're just letting your 401k sit there because you're not 73 yet, you're leaving 6 figures on the table. 3, Social Security timing is one of the highest return decisions you'll make. Delaying from 62 to 70 can be worth $500,000 in lifetime inflation-adjusted income if you live into your late 80s. Run the math for your situation. Don't just claim at 62 because you're tired of working. The retirement game isn't won by the person with the biggest number. It's won by the person who understands how money actually moves through the tax code and designs accordingly. Lazy investing built more fortune than crypto memes. But even lazy investors need to know which levers to pull. Most people retire in hope. You now know better.